Jerome Powell hinted at rate cuts and our portfolios received a nice bump. Thanks, Jerome. So what does this mean for income investors? Well, mostly good news, but some income investments benefit from rate cuts more than others. And today we'll look at 5. Today's income investments were chosen based on 3 criteria: their ability to deliver high income, the average yield is 11%. Secondly, their likelihood of benefiting from interest rate cuts. And third of all, some diversification. They're not all tech funds. They benefit from lower interest rates in quite different ways. A yield of just over 10% and the potential to capture some appreciation from tech stocks is what makes JEPQ so appealing. The stocks are mostly chosen from the 100 largest companies trading on the Nasdaq, a list that's also known as the Nasdaq 100. That huge yield is generated using a covered call strategy. That means they sell call options to give up some of the upside of their portfolio. Selling those rights produces regular income in the form of option premiums. The net of all that is a lot of income, but limited appreciation. Also, the income is heavily influenced by price volatility, so the payouts vary each month. JEPQ benefits from rate cuts because it's focused on tech stocks. Most companies benefit from an interest rate reduction because it reduces their interest expense, and lower expenses means higher earnings. However, for tech companies, the benefit is greater because they're expected to innovate and grow faster than other companies. Innovation and growth costs money. For example, hiring more software engineers to create a new digital product. As borrowing money becomes cheaper, there's more incentive to add more employees and fund new ideas and projects. Aside from borrowing money, tech companies also look to venture capital investors to fund growth. And those investors are more motivated to invest in risky tech if they can't earn high yields on risk-free treasuries. So to summarize, tech benefits from lower interest rates, which mostly helps growth investors and funds like QQQ and XLK. Income investors like me don't benefit as much, but we can generate some income from tech using funds like JEPQ. By the way, if you like income investments or you like growth investments but you're income curious, this channel is where I share what I've learned during the past 6 years of retirement, and also from current research from resources like Seeking Alpha's analysis, the REIT forum, earnings calls, investor presentations, and Contrarian Outlook. I mostly focus on stocks and funds paying consistent yields of about 8% or more, as explained in this video. If you think a 10% yield is high, TLTW is currently yielding over 18%, so obviously it comes with more risk. A lot of that risk is that it needs interest rates to fall in order to deliver a decent return, so it clearly belongs on this list of investments that benefit from Fed cuts. Unlike JEPQ, TLTW doesn't own a basket of stocks. This fund is based on Treasury bonds that mature at least 20 years from now. Those Treasury bonds don't pay anything like 18%, it's more like 3 or 4%. TLTW has been on a downward slide because it moves in the opposite direction to interest rates. If you hold a 20-year Treasury bond that pays, say, 3.1% and interest rates rise, a new 20-year bond would pay more, let's say 3.2%. Now your 3.1% bond isn't looking so hot. You could either sit on it for 20 years and collect the interest or sell it. There's less demand for 3.1% yielding bonds in a 3.2% world, so the price of your bond would fall. And that's been TLTW's sad story. As interest rates rose, TLTW's stock price fell. So what about the 18% yield? That comes from selling covered calls, a similar concept to JEPQ. TLTW holds shares of a long-term Treasury bond fund with a similar name, TLT. The TLTW fund sells call options on its TLT shares and receives income in exchange for giving up a portion of the upside. Now that you know what TLTW is, the effect of lower interest rates is clearly positive. In fact, TLTW has benefited from the expectation of lower interest rates, even though they haven't actually been cut yet. You can see the shift in expectations here, where the price bounced off the bottom. Next up is a real estate investment trust, or REIT, and it's currently paying just under 9%, which is close to its long-term average. But if you picked it up here in May of 2023, your yield on cost would be almost 12%. That was a steal. These charts came from a dividend portfolio tracker I'm currently testing called Snowball, as in your dividends grow like a snowball rolling down a hill. My free trial ends this week and I'll be switching to the paid version. If you're looking for an easy way to keep track of upcoming dividend payments, I'll put a link in the description for a 10% discount. Starwood Property Trust doesn't actually own property. It's technically a mortgage REIT or MREIT. That means it makes the majority of its income from lending money to real estate investors. MREITs are riskier than REITs because they're lenders, not landlords. Their assets aren't buildings, their assets are their loans, which carry higher interest rates than their cost of capital. In other words, they borrow at a low rate and lend out at a high rate. If the name Starwood sounds familiar, it's because the CEO of Starwood Property Trust, Barry Stonelicht, was also the founder of Starwood Hotels, as in Westin, W Hotels, St. Regis, etc. They sold those hotels to Marriott, and now he runs Starwood Property Trust and Starwood Capital Group. He's a pretty busy guy. But enough about Barry, let's get back to interest rates. Interest expense is a major cost for Starwood Property Trust. I looked at their last 10Q filing and their interest expense went up substantially in 2023. Over the past 9 months, it was over $1 billion versus $500 million for the same period last year. The only other expense that went up substantially was provision for credit losses, and that's also driven by higher interest rates. Revenue actually increased in 2023, but net income fell dramatically. There were several causes, but clearly one of the biggest factors was that extra $500 million in interest expense. Lower interest rates would reverse that trend. The fourth income investment I'll highlight today is in the energy sector and is currently paying a whisker under 8%. HESM Midstream doesn't find or extract the gas and oil. They do the boring work like transport, storage, and processing. Their revenue is mostly protected by long-term contracts that guarantee minimum payments, and that steady revenue turns into steady dividends. One of the things I like about HESM Midstream is that unlike JEPQ and TLTW's variable distributions or Starwood's distributions that have been flat for almost 10 years, HESM distributions grow consistently come rain, hail, or shine, or even pandemic. Once again, we go to the 10Q, and for the first 9 months of 2023, interest expense was a substantial chunk of total expenses at $131 million. It increased 21% from the same 9-month period in 2022. That's a huge increase, more than any line item on the consolidated statement. So, just like for Starwood, a reduction in interest rates for HESM Midstream would shrink expenses and fall straight to the bottom line. Before we look at the fifth income investment, a lot of the research for this video came from reports I read on Seeking Alpha. I don't buy a stock or a fund without first checking it on Seeking Alpha. Check the link in the description for current or upcoming promotions and free trials. Last but not least, we switch to preferred stocks and a yield that comes in at just under 10%. Regular dividend stocks can distribute whatever they feel like, so investors pay attention to the announcements each quarter to learn how much they're going to receive. Preferred stocks are issued with a fixed distribution amount, and that causes their prices to behave more like bonds. The consistent distributions are nice, but if interest rates rise, these fixed distributions become less attractive and the price of the preferred stock can fall as a result. When interest rates fall again, preferred stock prices will rise. Or to be more precise, the price of preferred stocks can rise on the expectation of falling interest rates. Hence, the recent bounce on this chart. This is PFFA. It's an ETF that holds a basket of preferred stocks. Investing in preferred stocks involves a bit of a learning curve. They can switch from fixed to floating rate. They can be called, which means you have to sell. There's a lot to keep track of. So a fund gets you exposure to preferred stocks without having to worry about all that stuff. There's one other factor that's important to understand about this fund. Most preferred stocks are paying more like 6 to 8%. And if you're wondering how does the fund pay almost 10%, the answer is leverage. And leverage comes with interest expense. So falling rates help this fund in two ways: boosting the value of preferred stocks and lowering the interest expense of the fund. I currently own all of the investments discussed today, partly because I like them as long-term income investments and partly because future rate cuts offer additional upside for them. And now you're up to speed on these 5 investments, so Good luck. Just kidding. There's a bit more to it than that. If any of the 5 look interesting to you, these reviews explore exactly how they generate their revenue along with the pros and the cons. Each one provides you with the key information you'd get from reading and researching for 2, 3, or 4 hours, boiled down into about 10 minutes. There's a lot of videos on this channel, so to make these 5 easy to find, I've created this playlist called Fed Pivot. That wraps it up for this look at 5 income investments that benefit from interest rate cuts. More armchair income coming soon.